All right, so LM2, what you need to know, and it's quite a bit of crossover here. Oh, no worries, thank you. Sorry, not MO5 today, LM2. MO5 is in a few weeks, so have a check on our events calendar and you'll see when that is. So LM2, there is some crossover with LM1. LM1, 2 and 3 all go really nicely together because they all complement each other in some way. And you probably will remember from LM1, or maybe even from your experience of working in the London market, that the London market is very unique because it operates on a subscription basis. A subscription market basis. And what this means is just that risks can be placed with lots of different insurers, each taking a portion of the risk. So as an example here, we've got a leader on a slip, Chaucer taking 35% of a risk, and then we have some followers on the slip as well, 20%, 25%. So risks are shared within the London market. So a broker will usually approach one underwriter to begin with, and if that underwriter is keen to participate, they will be referred to as the leader, and they will create the terms and conditions for the policy. So the leader has to take into consideration all of the different aspects of that risk and provide a good quotation and good terms and conditions. Because the market's so collaborative, the insurer wants to make sure that people are going to follow the leader, and that's why we call it the follow market. All of these followers in this example slip on the screen, they'll be trusting the leader, Chaucer's judgment on this case. And this following market, they can be made up of a number of insurers. We need that because we have to place the risk 100%. But each insurer that agrees to take a share of the risk is actually making their own contract with the insured, and they'll be liable for their share of any losses that arise from that risk. Any follower can request a higher premium than that of the leader if they can justify it. So sometimes, the leader might not have the biggest portion of the risk. That's okay, that's normal to see. So then it gets us thinking about, why would an insurer only want to take a portion of a risk? It could be due to capacity. They just can't write any more business. They don't have the authority to write anymore. Or it could be a bigger portion of, if they take a bigger portion of the risk, it's really going to affect the balancing of their portfolio of business. It could be a new area of insurance, so they just want to try it out for a little bit at a smaller stake. It could be due to geographical restraints. Brokers and clients can have a big influence over this as well. So it could be their influence. Could also be due to risk aggregation. So insurers will monitor the location of all the risks that they're insuring, just to make sure there's not like a concentration of exposure in one place. You've also got to be really mindful of risks being written in multiple offices. And you might find that branch offices are competing with each other. So we have to bear in mind these branch office controls as well that will be in place to make sure that a company isn't competing with itself. So risks can be placed outside of the London market as well. We call this the company market. This could be because of where the risk is. I think the book talks about the Scandinavian market. They're quite loyal to their home market. It could be, the culture, the local knowledge and the relationships that have been built, or it could just be because the insurer is a specialist in a particular field, or they've got a really good claims service and they want to place it with a company market insurer. So just as a bit of a reminder about different types of insurance companies, they come in different types of ownerships. So we'll just go through these quickly. Remember, Lloyd's is a marketplace and an institution. It's not an insurer. We've also got the company market outside of the London market. We've got reinsurers who offer reinsurance business to insurers who want to insure their risks. We've also got P&I clubs, so protection and indemnity clubs. They're exclusive to marine. I remember this because it sounds like P&O, like the ferries, P&I, it's all to do with marine. We've got proprietary companies. These are companies who are owned by the shareholders. Very easy to ask questions on these. Which type of company is owned by their shareholders? And you might have mutuals, captives, proprietary. It'll be a proprietary insurer. Captives are insurance companies who are owned by their parent company. Again, another really easy question for the CII to ask you. And this is where a company is so big, it decides to effectively insure itself and create an insurance company for its own benefit and its own needs. We usually put these offshore for tax efficiencies. I find that quite easy to remember. Captive companies, and I always think being held captive on an island, usually offshore. Got a few weird ways of remembering things, you'll find. We've got Lloyd's service companies. So this is an approved cover holder, and they obtain authority from a syndicate to write business on behalf of the syndicate. And in the London market, what's important to note as well with the companies is that sometimes we do see insurers who operate as both insurance companies and Lloyd syndicates. So Chaucer, for example, Hiscox, Hiscox have syndicates within Lloyd's, but they also have a presence in the company market. So bear that in mind. Mutual companies are owned by the policyholders. So again, this is something that they could throw into the mix in a multiple choice scenario. And then we have the self-insurance. So this could be a company maybe having quite a large retention or deductible. So they're self-insuring a portion, or it could be structured self-insurance as a whole, perhaps. So insurers operating as both insurance companies and Lloyd's syndicates, which we mentioned a minute ago, they could have a Lloyd's platform and a non-Lloyd's platform to write risks. And the Lloyd's brand is internationally recognised, and the permissions can be granted for Lloyd's to do business with certain countries where the insurance company side may have been refused in the past. So they may have access to more geographical sort of locations through the Lloyd's brand. So there are some benefits when they're trying to decide how to place their business. Insurers can also spread their capacity, so they can insure some risks in the Lloyd's syndicate and then insure some through the insurance company just to spread the capacity. Insurers may also choose not to trade through a syndicate, but rather the insurance company, because there's additional regulation for managing agents, and they might want to just sort of weigh up the pros and cons in that. So there's a number of different reasons why they might choose which one they're going to do. Now, just towards the end of chapter 1, we're at the end of that chapter now, so only 12% of the risks at Lloyd's are from the UK. So this is an international marketplace. So we have to bear that in mind when it comes to sort of the source of risks. And Lloyd's has licenses and authority to trade in over 200 countries and territories. When I hear the word licenses, this just means permissions. They have permission to do it, but we refer that to that as a license. So they will either be, you might have read in the book, they'll either be a licensed or eligible surplus lines insurer, which means it's not actually authorised, but they're just eligible to place insurance, or they might be authorised and registered as a reinsurer only. In the USA, the licensing is a little bit different. They do this on a state-by-state basis. So Lloyd's or insurance companies have to negotiate the permissions with the individual state regulators rather than the federal government themselves. For reinsurance business, Lloyd's is licensed in all of the US states. For direct business, Lloyd's have made the decision that it would be a US surplus lines and reinsurance business rather than admitted business through licenses, and they gave up some of their licenses.